Hello, everybody. Welcome back to the channel. My name's Max. You can find me on Twitter at MaxConvexityMan. Have a good feature planned out for you tonight. I'm going to look at what the Yieldmax managers have done to the Ulty's strategy. Yes, part of the Ulty's strategy is a minor change to how they're doing the options, but it's a lot bigger than that. Jay Pestrichelli, Scott Snyder, the head trader, and Mike Coe, and the rest of the team over at Yieldmax have rebuilt this baby from the ground up. Stick around and we'll get right in the middle of it. The managers at Yieldmax have a history of being proactive about listening to the consumer. The first change Jay and the team made was largely due to me and people like me shining a light on the fact that the old-fashioned option strategies were not as good as they could be. Your father's covered call strategy fully kept the upside stock appreciation of the underlying asset. The very first time I had Jay on my channel, I told him, I said, Jay, why don't you guys use a spread to make these more appealing for folks expecting some NAV growth? Within a few months, Tidal, the parent company behind Yieldmax, released SPY-T and Triple QT, which are actually Defiance properties, but these strategies did just what I suggested. And instead of covered calls, they sold covered call spreads. The spread strategy also was implemented at Yieldmax in the single stocks. Within a month or two after that, Yieldmax started selling covered call spreads on all of their single stocks. Now, the spread strategy did minimize some of the bad stuff that old covered call strategies did or didn't do. They uncapped part of the upside, and that was a big deal. Now, the next change in Yieldmax had nothing to do with me, and in fact, I was against it. But folks were clamoring for weekly paying ETFs. And within a few months, sure enough, Yieldmax added weekly pay. This spring and summer, the market had a huge rally, and retail piled into Ulty. This summer, Bitcoin went from a low of about 70,000 to a high of about 110,000 by mid-July. At the time, ULTY had a portfolio highly concentrated in Bitcoin and tech companies. Sure enough, ULTY did awesome. Retail noticed how well Ulty was doing and piled in, taking Ulty's assets under management from 191 million to 3.2 billion. Ulty's NAV at the same time went from around $5.30 to more than $6.40. So over this time, Ulty had positive NAV growth and was paying around an 80% annual yield in weekly payments nonetheless. Retail traders were in love with Ulty. Folks took out home equity lines of credits and started planning their retirement. Folks started quitting their job. What followed was the reversal and retail backlash. Roll that forward to now, Bitcoin has nearly round-tripped that move from this spring, as the price has fallen from more than 130,000 to just around 81,000 the other day. Sure enough, ULTY round-tripped their NAV and then some. Now, sure, ULTY still is paying that huge dividend, but the NAV is under constant pressure from the price of Bitcoin. The retail community absolutely lost their mind, and they let Yieldmax know about it. Of the 3 billion Yieldmax or Ulty used to have under management, I would say about 2 billion of that was from customers that didn't really understand how these ETFs work and how correlated the results of these ETFs actually were to Bitcoin. Sure enough, Ulty's AUM dropped to 1.3 billion. The folks that are still left, including me, have been clamoring for a more sustainable, more robust strategy for Ulty. Everyone wants a high yield, but a high yield is directly at odds with NAV growth. I understand this. I don't expect NAV growth from Ulty. Retail was not hearing any of it, though, and they've basically been calling for the managers at Ulty to be perp-walked. The good news is Ulty has been rebuilt from the ground up. To the untrained eye, it might look like they added an extra leg to their option strategy and put some more blue chips in like Google, but it goes way deeper than that. This fund went from a speculative high volatility portfolio to a quality growth portfolio and with controlled volatility. The 100% turnover in Ulty'S portfolio shows they're listening to their investor base and they're willing to make changes. Whether this is the right move for the long term remains to be seen, but what is clear is they've addressed the immediate concerns revolving around NAV stability. The old portfolio had an average volatility of 77%. The old portfolio was highly correlated to Bitcoin and tech generally. You had a bunch of quantum computing in the old portfolio, such stuff, things like Rigetti. You had a bunch of pretty much direct Bitcoin exposure, like Mara, MicroStrategies, Iron, Coinbase, and you had a lot of small cap, highly speculative names like Rocket Lab, SoundHound, etc. The original design, while executing its high volatility goal, did a great job of getting high volatility, but it created significant NAV volatility. And it, like I said, it really concerned the income-seeking investor base. Management listened and they responded. Community feedback on social media, like I said, was particularly vicious. But the response, in response, these guys completely changed their portfolio. They haven't kept one thing in common with the old portfolio. I pulled up a portfolio from last month before they made the change, and I compared it with the portfolio from this month. So the new thesis is this: we're going to switch to sustainable quality growth. Like I say, October, it was maximum beta speculation, maximum risk on. And it was that way all summer. And it served Ulty very well during the summer. I mean, Ulty had a heck of a summer. However, like I say, this fall, when Bitcoin prices reversed, it's been a different story. The old investment thesis was high risk, high reward, and we're going to speculate across many sectors. The old portfolio had an average volatility of around 77%, and that's pretty close to what type of yield it was paying also. Quantum computing, crypto miners, those things are highly speculative, and as such, they have very expensive option prices. So you guys know Ulty sells options on these types of stocks and to create a yield. And they were creating around an 80% yield this summer, and it makes sense because the average volatility was 77. So nowadays, the investment thesis is sustainable quality growth. We're going to have controlled volatility through established quality names with a proven business model. All right, so the new characteristic is the volatility is much lower, about half the volatility. I took a recent portfolio. I took Friday's portfolio, Wednesday's portfolio, and it has an average volatility of around 36. That's a good news, bad news situation. The good news is the NAV should be under less pressure, but the bad news is the option selling strategies won't be able to earn as much money because it has less volatility. Remember, options are priced based on the volatility. This new build is targeting an investor that's income focused, but also wants sustainable yield and growth. Here's Ulty's 8-pillar plan. First pillar is mega cap tech, and this is in their portfolio right now. They have Broadcom, they have Google, they have Facebook, they have Lam Research, and others. Pillar number 2 is broad market exposure. They actually have the Qs in their portfolio right now, which gives you access and exposure to the NASDAQ. Pillar 3 is adding some Eli Lilly, which is a highly defensive healthcare stock, and it's very, very uncorrelated with the market. Pillar 4 is to add some established blue chip financials. You have Morgan Stanley, American Express, and the like. Pillar 5 is some quality infrastructure plays. PRW or PWR is Quanta Systems. Pillar 6 is adding some defensive hedges. We have gold and we have bonds. They have TMF, which is actually triple leveraged bonds. Pillar 7 is some proven growth stocks. What about some SoFi? What about some Teradyne? What about some Twilio? Pillar 8, some commodities. What about Alcoa? What about Southern Copper? Both of those are in the latest build of Ulty. So, like I say, the results are kind of a good news, bad news. The volatility's gone down, but I think I'm a little afraid that the yield will go down as well. This is a trade-off, though. In October, the portfolio was not very diversified, or I'm sorry, was diversified, was actually more diversified than it is now, but it wasn't very correlated. In October, the portfolio had 21 completely uncorrelated speculative stocks. Each position moved independently, and it created the mirage or the illusion of mathematical diversification, but it was kind of a hot mess. So nowadays what they've done is they hold 70 quality stocks with actually higher correlations to each other. And they're doing this so they move in a more cohesive, predictable manner. And the idea is that it should protect the NAV a little bit better. All right, so these managers made an intentional trade-off. They're sacrificing the appearance of diversification, and they're trying to add in some real world stability. Actually, in October, they held 21 completely uncorrelated speculative stocks. Each position moved totally independent of each other. It was kind of chaotic. It did create the illusion of diversification, or it was diversified. They've actually undiversified it a little bit in November. Now they have 17 quality stocks that are more correlated with each other, but the idea is that the positions will move more cohesively and predictably and hopefully protecting NAV a little better. That's the whole idea. All right, so let's look inside the new portfolio. All right, so the best portfolio diversifiers, these are the shock absorbers. This is the Treasury bond ETF. That's TMF, the 3 times levered Treasury bond. It has a correlation of only 4 out of a possible 100. 1 or 100, however you want to think about it, is perfectly correlated. And so 4 would be 96% uncorrelated is one way to look at it. They also have gold in here through the ETF GLD. Now, this one has an average correlation of 11. So it's 89% not correlated is the way I look at it. Then they have Eli Lilly. Now, Eli Lilly is extremely defensive. It's a good company. It's a growth company, to be sure, but it only has a correlation to the broader market of 14, meaning it's not very correlated at all, and therefore quite defensive. Now, the key risk considerations are the tech sector clustering. So there's high intercorrelation in the new portfolio between the Qs, between Lam Research, Teradyne, Google, Broadcom, and others. There's some semiconductors in there too. So Lam Research, Teradyne. And the thing is, one of Yieldmax's most successful ETFs lately, or 2 of them, have been SOXY and Chippy. And both of those also use semiconductors. We also still have a growth thesis, quality growth thesis. I mean, look at the 5-year annual return of Broadcom. It's making 62% a year. Eli Lilly, strong growth, not correlated to the overall market. And of course, Quanta Services also. Then the managers are also looking at risk-adjusted reward. And of course, Broadcom, Eli Lilly, and Quanta Services also have that as well. But then also they've added in some stabilizers like gold. So they've achieved a 52% volatility reduction. The portfolio is fully aligned with the investor demand for stability. They removed pretty much all the speculative and high risk positions. They added some sustainable quality growth. And of course, don't forget about the speculative hedges, gold and bonds. This is a management team that listens to consumers. They turn over their portfolio 100%. They don't have one issue in common from a month ago. Hopefully they prioritized investor experience. Ulty currently has about 1.33 billion under management as of the other day, 346,000 shares. We'll see if they can keep up that 83% distribution rate. I'm kind of thinking not. My specialties options, if you made it this long, I'm going to show you real quick what they did to the option strategy, because the option strategy is a big part of this also. Because yes, while it is true they cut the volatility out of the portfolio, and that can potentially cut some of the yield out of the portfolio, the option bros over there at Yieldmax know what they're doing. And let me show you what they've done. I've loaded up 2 trades, and these are trades that ULTY has on right now. The first one is in Teradyne, and this is the old option strategy. And they're still doing the old option strategy on some of the more volatile names like Teradyne. The old option strategy was they own shares of the stock. They sold an out of the money call. In this case, they sold a 185 strike call. And then they use part of the proceeds from that call to buy an out of the money put. The out of the money put serves to cap their maximum downside or define their risk, put another way. Now, it doesn't make them immune from losing money. If Teradyne goes down, they could still lose 20% on this trade right here. However, Teradyne's only about 5% of the portfolio. 5% times 20% is 1%. So in the worst case scenario, this, if Teradyne crashed, it could cause a 1% drop in NAV of Ulty, which isn't good, and it's not what they're going for, but at the same time, it's not totally destructive. Now, the new build is doing a 3-leg strategy like this. This is also has defined risk. It's also a form of a collar, and it's pretty much the same idea, but they've just sold an extra option. They still sell an out of the money call, but now they sell an out of the money put option too. Well, the out of the money put option brings in some more yield. It brings in some more money. Think of it as they're double dipping. And they're doing this especially in some of the less volatile names that they have in the portfolio, like Google. They have this trade on in Google right now, and they have it on in some of the more blue chippy names. So this taking a double dip at the at option selling, it does a couple of things. It should increase yield a little bit. The other thing that was killing Ulty was the construction of the collars. You have this out of the money put, and it defines your risk and everything, but it also bleeds, because when you buy options, they have time decay, and this time decay was hurting the time decay from the puts was hurting the return of the portfolio too much. I believe that's what the managers at Yieldmax thought. So by doing this strategy where they sell a call and a put, and then they still buy an out of the money put, they still own stock. It's the same thing. They still have capped downside, but what this additional sold put does is help to limit some of the drag or some of the bleed that the put they were buying creates. They still want to buy the put to have defined downside, but at the same time that they sold a put that was a little bit closer to the money, the sold put actually brings in some time decay. See that where it says theta right there? This option right here brings in $19 a day per contract. Okay, that $19 a day helps to offset the theta decay in this option. See this option right here? It's negative 12. That option cost $12 a day. So by selling the option that brings in $19 a day, they negated a lot of that time decay. And like I said, it also is going to help boost the yield a little bit. I still think the new ULTY is not going to yield anywhere close to 80%. I've run some numbers on it, and I'm thinking more like around 60%. However, and I think some people will be mad about that, but I think most people would take 60% if they could get a little bit steadier NAV. All right, here's the bottom line. Yieldmax executed a complete portfolio change. They went from speculative high volatility portfolio to like a quality growth situation. The 100% turnover in the stocks inside the portfolio shows they're listening to the investor base and willing to make changes. Now, whether this is the right move long-term remains to be seen, but it's clear they've addressed the immediate concerns about NAV stability. I'll say this, if Bitcoin goes to back up and makes an all-time high, it probably would have been better off to stay with the old build. I mean, you can't predict the future. However, this new build should be more of an all-weather strategy. It should be, I think it should have a good use case for more investors. Let's just say that, a broader scope of investors. Hey, thanks for watching my video. Remember, nothing you hear on my channel is financial advice, and please check anything and everything you hear on social media with a licensed financial advisor. A good advisor knows your situation, and he can make recommendations custom tailored for you and your family. If you like this type of content and you'd like to give me a tip, please go to paypal.me/maxconvexity. I always appreciate it, and it helps keep me interested in bringing out compelling content like this. Also, don't forget to like and subscribe. Have a great Thanksgiving. Max out.